Hello and welcome to Property Mastermind podcast with Bob Anderson and Hilary Saxton, episode 155, using residential finance for property development. Today, Bob and I will look at how you can use it, why you would want to use it, and why you might not be able to use it. Let's jump on into episode 155 and Bob and I will unpack that for you. It's going to be a fabulous episode. Hello and welcome to episode 155. Hey Bob.
G'day, Hilary.
By the way, we're talking about using residential finance for property development.
That's a good one to do.
It is a good one.
Anything to do with finance, I like.
Yeah. Bob's favourite thing is finance. He is the finance.
I'm a weirdo.
Yeah, you are. Well, two things. You are. Three things. You are. Number one is giving away Secrets of Property Millionaires Exposed this week to Sam Cooper. Sam, in the post, I have your address. There's no T on the end of that. I'll pop that in the post tomorrow. Well, I'll get somebody to do that. And you will enjoy heading to page 121. The second thing I want to talk about is, Bob, guess what?
What?
Well, have you got a tip ready? Because you won't have, and right now you'll be freaking out. And I'll afterwards I'll say, I'm going to ask you that every time. Got any tips?
No.
Oh, come on. Nothing.
Well, I have got one.
What's your tip?
State of origin.
State of origin.
Queensland to win the series.
Queensland to win the series.
Win the series, which is 2 out of 3 or 3 out of 3 at the moment. That's rugby league, by the way, if you don't know. Could be anywhere in the world watching this.
So this is prior to game 2 being played. So you think Queensland will...
And Queensland's got to win 1 out of the next 2. New South Wales have got to win 2 out of 2.
Oh,
they can do it.
Yeah.
But will they do it?
Yeah, well, they played with the man down last time.
Naughty man.
Yeah, I know.
Well, we'd lost our top fullback. But anyway, there you go. So that's my tip.
That's your tip?
That even if Queensland lose game 2, game 3 is back in Queensland. So
all right.
That's my tip anyway.
I'm excited.
I can tell you,
2.
I don't live or die off it though.
No, you don't.
If I had a better offer, I'd even do it.
Yeah. Okay. Well, Bob, today we are talking about using residential finance for property development, and I'll unpack the reason why I chose this topic.
Okay.
The cheeky one. I was talking to somebody recently and they wanted to do property development, and they were just talking to me about the courses and what we offer. And he said, "Oh, no, well, I can't. I actually am just going to leave it a week a year or so, maybe 2 years. I don't know, a year, like a while, because I'm tapped out with finance." Now, we'd already talked about how much equity he had, which was over $1 million. And I said, "You've got a lot of equity there." And he said, "Yeah, but I can't use it." And I said, "You could use that with commercial finance." And he said, "Oh, no." And I said, "Why?" And he said, "Because the interest rate's too high." I said, "Most people do property development with commercial finance." And he said, "Well," in his really polite way of speaking with me on the phone, he said, "Well, how much is the interest on commercial finance?" And my answer was, it's a lot cheaper than doing nothing. And I thought, yeah, that's true. And it is a lot cheaper.
The cost of doing nothing is extraordinary.
Way more than the interest rate difference of what, 2-3%? Or what was that?
If you put off property development for 2 years, you could have done a project, made several $100,000 depending on what it was.
Yeah.
And so basically you're saying goodbye to even on a duplex, you could be saying goodbye to $400,000 or $500,000 by putting it off 2 years.
So that was when I got off the phone. I just said to Bob, "Wow, interesting people's take on things, or their." And I think it's probably just the level of understanding. Really, they probably just don't realise that. And
yeah, a big level of not understanding, but
yeah,
it's just ignorance, not knowing.
Yeah. And not ignorance in a negative way, the word meaning not knowing, not that they were, an ignorant person. So anyway, that was that conversation. And I said, "Oh my goodness, this has to be a podcast," because as I said, most people do use commercial finance for property development. So, Bob, let's look at why and how, because ideally, residential finance would be cheaper, yes.
Mm.
And in the perfect world, and in your earlier days, it was all resi, wasn't it?
Oh, look, small projects up to 4 packs were often done on residential loans, retail loans, if you
Mm.
like,
Mm.
with the banks. Many years ago. Yeah, I did plenty of those. But over the years, retail banks sort of opted out of things like property development because they make so much on fees these days. I mean, they used to make most of their money on the margin between what they interest they pay on deposit and what they lend out. But these days they make, I think, more than half their profit just out of fees. So they sort of moved away from that. And if you think about the banks do have a commercial division,
Mm.
but you never see it in normal life, and you don't get to talk to those people. But we see retail finance everywhere, don't we? You go to the Westfield shopping centres, or you go anywhere, you see there's a whole aisle full of banks, isn't there?
Yeah.
They're there, the big four plus the others. Suncorp, Bendigo, Bank of Queensland. They're all there flying their flag, and they're retail banks. And most of their money is made on fees and just simple home loans or investment loans. That's where they make their money. So they charge a low interest rate. Well, we might think it's low, but basically it's a low interest rate for a long period of time. 20-year loans, 30-year loans, low interest, yeah, and that's how they make their money. But yeah, they've sort of moved away quite a bit from.
How long ago was that move, Bob?
Oh, it's probably definitely after the GFC, banking changed quite a bit. So we definitely didn't see much then.
Mm.
Pre GFC, early 2000s up to maybe 2006, 7, you could do it a bit. Even like Bank West banks like that, you could do even up to a 4 pack, even a 6 pack. Although they had some weird rules, like you couldn't for a while there, you couldn't do it in an entity. You had to do it in your own name. Well, that sort of kills the incentive a bit. Like
Mm.
this is not now, but back then, because if you do a development in your own name, well, first of all, you're risking yourself personally, and you end up your profit is paid as personal income tax. Well, none of those things do you want.
Mm.
But look, I suppose that you asked the question: can you do a development today using retail or resi finance?
Yes.
Well, you can sometimes with some people. So we have seen a few people do small projects. I'm not seeing anything bigger than like a duplex
Mm.
being done on resi, and usually the bank would reluctantly do it. And what I mean by that is the client would probably have other business there. They might be a good client. They might have business banking there. They might run their business with overdrafts. They've got maybe some plant and machinery, which has been financed from the bank or whatever, investment properties. They're a good client of the bank, and the bank might reluctantly finance that project.
Mm.
The other reason that they might do it as well is if you're going to keep the product. If you're going to do something not too big like a duplex and you're going to keep both of them, or maybe one, maybe they'd do it for one, not sure. But certainly if you're going to keep both of them, because what they can do then, they can switch that into a long-term investment loan.
Yep.
So
And they love those.
they love those, and that's how they make their money,
Mm.
long-term lending. But generally, it's not easy. What'll probably happen if you rock up with a property development to a retail bank? They'll be pretty straight up and tell you they don't do them. They might recommend you talk to their commercial division where the bank does commercial loans, but banks don't lend a lot on property development these days. Most of the lending's in the non-bank sector. Back probably pre-GFC, about 80% of development finance was done by the commercial arm of banks
Mm.
and little ones by the retail. But since then, it's swung the other way.
Was that commercial stuff cheaper than what we're looking at now, the private lending commercial?
Well,
Or
the
on a
rate the
par?
rates go up and down like the
Yeah.
resi rates do, really.
But at the time, was it on a par with that?
I can remember pre GFC, I think I was paying about 8% for money,
Mm.
which is not much different from now. Bank money is around, depends if they run line fees or not, but These days, yeah, post GFC, the resi banks pretty well pulled out of all sorts of development, other than the very rare one, unless you're going to keep it or you're an exceptional customer. And also on the commercial side, most of the banks pull back. They tend to do larger projects with long-term clients, but 80% of the market in the commercial lending market is done by non-banks or private equity these days. And so, yeah, it's not like resi loans aren't easy to do on a development. Remembering though that, like, when you do a development, typically there's two stages, isn't there? For
Yeah,
finance.
you've got your purchase and then you've got
Mm.
construction. So, are you going to tell people to sneakily buy in there?
Oh, I knew what you were going to say
Are
there.
you going to tell people to sneakily buy an investment property with resi finance and then accidentally decide to develop it and then go for commercial?
I like your thinking.
Yes, is that what you were going to say?
Well, I was getting around to it, but
Yeah.
you said it there. So typically, there's two stages of financing and development. The first one is when you buy the site, and usually the site does not have an approval. It's what we call a raw site. And then you buy it, you settle on it, you get your development permit, you get your building permit or CC, and then get to the point of being ready to build. So you've run a tender, you've got a builder lined up. Then usually that's the second phase of finance, because now you need some serious money to build it, to construct it. And so that might mean you can run with the same financier that you bought the site with, or it might mean that you change financiers, because there's plenty of financiers around who do construction loans but don't really do the site purchase loans. And you might get a better deal at that point. So if you went to another financier at that point, they would pay out the
First
finance.
one.
Yeah.
And you know what? That's always a question people have. They don't.
Mm.
That's not always, but often. That's a question that people have. Oh, I didn't realize that that's what happened.
Yeah.
They pay out the first one, and then your interest, because it's commercial, is they loan you the
Whatever it
interest
is.
as well. So you're not having to make payments. You do
Mm.
not make payments during property development on interest.
Well, yeah, it's capitalised.
So they
So
give you the money to make the payment.
they give you the
It's a
money.
great system.
Yeah.
They give you the money to pay them back.
Yeah. So just back to this second loan,
Yeah.
it could be with the same financier, or it could be a different one. But you're right. A lot of people say, "Oh, I can't run two loans at the same time." Well, you never will, because whoever the financier is, they want a first mortgage as security. So you can't have two different banks having a first mortgage. And so the second bank, when I say bank, I really mean a financier. The second one will pay out the first one, so there's only one financier, and that could be commercial. So what some people do, they buy the site using a residential loan.
Mm.
And the advantages, well, there's a few advantages with resi loans, isn't there? Like
Yeah.
lower interest rate, lower application fees. There might be reasons why you'd want to try and use a resi loan for the site acquisition.
Mm.
If you told them the whole story, I'm going to buy this, then I'm going to get some approvals, and then I'm going to construct, whatever you're going to construct. That's when the conversation will probably end.
Because remember, banks make money from long-term lending, so
Retail banks.
they don't like the idea of you cutting it short within sort of a year
No,
to change your mind.
no, they'd make nothing out of that.
But
Probably a
if you
retail bank.
accidentally did that and changed
Well,
your mind, because you
they're
don't
not.
always know you're going to do a property development when you
Well,
buy a
look,
site that's
I'm not recommending it, but
no.
what some people do is they just say, "I'm buying this as an investment," and so they get an investment loan with the advantages that you get from a retail loan,
Mm.
and then when they get their development permit, their building permit, when they got the builder lined up and everything, and they need some construction finance, they then switch to commercial lender
Mm.
and drop the retail lender. The retail lender is pretty PO'd at that point
Mm.
because they've basically been fibbed to, and they've carried this loan for only 6, 9, 12 months, whatever it is, at a low interest rate, low application fee,
And fair enough too.
and
Banks don't make
and
much
that's
money.
it.
She says cynically.
You probably wouldn't do that a second time
No.
with the same bank, but some people do that who want to try and get that resi loan and just buy the site as an investment. We've seen some of that unravel though, haven't we? Where people have tried to get a resi loan. Now you might remember this one, Hilary. A guy
Buying the
signed
site.
up
Mm.
for a resi loan, and it was like a 60 or 90-day settlement period. And so to get started, which you can normally do, he started on his development permit.
Mm.
So rather than wait, let's say the 60 or 90 days till he's settled and then start on the development permit, he thought, which we often do as
Yeah.
developers, if we can
Get
get
underway.
if we can get a longer settlement and get our development permit underway and even get it lodged, you can do that.
Because it means you're not paying for money for as long.
Mm,
Yeah, the cost of
yeah,
money.
yeah, because you don't own it yet, so you're not paying interest on it. If you can advance your development permit, you're shortening up the length of the project when you're paying interest.
Mhm.
But what he did, so he did that, and he moved along, and he lodged his application, and then just before settlement, the bank, as it was, said, okay, sent the valuer out to value it. And so, being a rather astute valuer, he checked on whether this thing had on the council website actually, and discovered that a development permit had been lodged in the last month on the site. And he told the bank, and the bank just pulled the loan.
Done.
So all of a sudden, he's stuck with a settlement 3 or 4 weeks away and no finance because the bank pulled the rug because they found out it was going to be a development site. So that was a bit of quick work with a non-bank lender because they can react quite quickly and you can get quick loans. So he ended up, higher application fees, higher upfronts. But that just shows you how sensitive they are to doing developments.
So, Bob, what would be the negative? There's usually a pro and con. What would be the negative to residential finance if you were going to use it?
Well, if you're going to use it to buy the site, you're probably not going to get construction finance. And if you use it to buy the site, you might have to tell a little fib. You might, like this is what some people do. They don't say they're going to do a development, or if they do, then they say they're going to keep them and end up selling them instead. Or so getting around that, you definitely want. Here's a key tip: if you're going to try and use resi finance, get a good finance broker who also understands development finance, not just your regular resi. Because I've seen resi brokers front up to a financier, to a bank, and actually spill the story that it's going to be a development, and then they just get slammed, like shown the door. So,
Oops.
so not do that. But in terms of advantage, I mean, the advantages are obvious on resi: lower interest rates, lower application fees. You just treat it like a loan. If you happen to get residential for development, would actually run all the way and construct, give you a construction loan, which would be extremely rare. But if you did, they don't always lend you as much money as a commercial loan because there's a few tricks that they do with resi loans. You've got to watch them. What they can do is they'll lend you what they call a percentage of the end value. Now, that's not unusual. A lot of financiers lend you a percentage of the end value, and in the commercial world, it's commercial finance. It's very common. But what they don't tell you, and there's a little phrase here, in one line. So what they might say, look, we'll lend you 75% of the end valuation in one line, and you might think, 75% of what it's worth at the other end when it's
3 million.
finished.
Yep.
Well, first of all, they take the GST off. So you could lose an 11th of that there before they do their 75%. But when they've got in one line, what that means is let's use a duplex as an example. It's what the duplex is worth when it's still one title on one block of land before the title is separated. And you might say, well, that's not worth a lot less than two titles. But the way they instruct the valuers to do it, I've seen it 10 or even 15% lower in one line than what it's worth on two titles
Well, what would be the reason for doing
to lend
that?
you less money.
But in one, how would you even value something before it's on two
Well,
titles? Why would they even do that?
well, that's just the way that it's written in one line.
Mental.
And it's worth less. In my opinion, it's not worth a lot less because it doesn't cost much to actually split the title. But it's the way they value it. And normally the valuers, and I've spoken to plenty of valuers, their instructions are to reduce it by 10 or 15%. And what that does you might be getting 75%, but you're getting 75% of a low figure.
Mm.
And so it's not unusual in residential construction loans, if you can even get one,
Mm.
if it's going to be valued in one line, to end up with probably about a 60 to 65% of end value uh, as your loan.
Mm.
And quite often you can get better than that in the commercial world.
We had that this morning even. We were looking at refinancing something, and
Hmm.
it was refinancing something to extract as much money as you can, because unlike my friend I was talking to this
It's
morning,
an equity release.
yeah, equity release to do something else with that money, whether that could be done through residential or commercial finance. And exactly that. Bob said, well, it depends what they're valued at, because
It's a specialised security, though, what we're talking about.
yeah, but the residential finance might be cheaper in some ways, but I might get a lot less. So there's the weighing up the use of the
So
money.
you got to watch when financiers talk about, oh, we'll lend, particularly retail banks do this.
Yep.
We'll lend 75% or 80%. Well, whenever anybody says percent, first thing I ask, percent of what?
Mm.
And in this
The way
case,
you say it, percent of what?
yeah, and in this case, like you got to watch that terminology if a retail bank ever uses it on construction line, 70 in one line, because
Mm.
it'll be way less than what it's really worth at the other end. And so the percentage amount might look high, but it's the percentage of a low number,
Mm.
and you could be worse off. But as I said, it's pretty hard to get anyway. But commercial loans are fantastic, really, because some people think, oh, commercial loans have to be big, like a lot of dollars. I've seen commercial loans $500,000, $600,000. They don't
Mm.
have to be big dollar items. But yes, the application fees are higher. Yes, the interest rate's higher. But you can often get a bigger loan. So
Mm.
the bigger the loan is, the less equity you have to put in,
Mm.
which could be quite important.
But it could mean the difference between doing something and doing nothing. And we
Yeah,
said the cost of doing nothing
yeah,
is expensive.
yeah. And as you said before about the interest, the big difference between commercial loans and normal retail loans is retail loans, you have to prove serviceability. You have to prove that out of your net income, after all your expenses, you can pay the interest.
Mm.
Whereas with a commercial loan, as you said before, the interest is capitalised. So it's part of the loan. They actually lend you the interest.
How good's that?
Yeah. So let's say
It's like the best thing ever.
it is.
Yeah.
So that interest component, what they call an interest cap, they lend it. It's part of your loan. They just quarantine it over to one side. And each month when your interest is due, they just take this month's interest out of the interest cap and pay themselves. And so you don't have to prove serviceability at all, because it's all there. It's already paid for. It's sitting over there. And that individual, that person that you had a conversation with, that you started that story at the beginning, they didn't realize that when they said, "Oh, I'm tapped out," or "I
Yep.
can't borrow any more money," what they really meant is they had 3 or 4 investment properties. They were all geared up as high as you could gear them. Um, Now they still had some spare equity, but they couldn't do anything because their serviceability was tapped out.
Yeah, that was it. They had massive equity. Yeah, it was just
Yeah.
serviceability tapped out.
If you think of a retail loan, there's 2 components. One is your deposit. The other thing is your serviceability.
Mm.
So you may be short of one, but not short of the other. It might be that you've got a really good job, you earn lots and lots of money, you've got great serviceability, but you haven't really got a deposit. Or it might be that you've got a deposit, but you're just working part time, you don't have much, income, and therefore that stifles you. Or it could be that in this person's case, they had surplus equity, but they were tapped out on their residential
Serviceability, yeah.
loans through serviceability. But in a commercial world, they might be able to tap that equity and the serviceability doesn't matter. So they could actually do something
Mm.
using commercial finance with capitalised interest.
Yeah.
Yeah.
Sounds easy to me, Bob. Sounds super easy to me. And
Yeah.
again, it goes back to the cost of doing nothing.
The cost of doing nothing is enormous.
But while we're on that, because I like those words, and I actually wrote down to say, and during this podcast, because today we've talked a lot about the 2 types of finance, but I wrote down your life is made up of everyday choices, and it's that person's right to have to make that choice. Obviously, it's my right to make my choice, but I think we've got to start making informed decisions. Making a choice I don't think there was a full understanding of the possibilities available, and I think that happens a lot. And I know this information we've talked about before, people have said to me, oh, I didn't realize you could do that. And that's awesome, because we
Yeah.
open the door to possibilities for everyday people to do extraordinary things, and how good's that? But I think I really want people to understand the cost of doing nothing is also an everyday choice, as in we put it off all the time. People put off doing what they want to do,
Mm.
whether it be because they think they can't get finance, or they just let life get in the way because they get too busy, or there are lots of different reasons. We think, not now, I'll wait until, and there's always going to be a reason we're waiting until.
Mm.
And if you have been on the fence for a while, you're just going to keep finding reasons to be too busy. And if you ask anyone who does it, you, me, and others, we all wish we'd done it earlier, faster, more. It's just one of those things that's so jolly
Yeah.
addictive. I saw a great actually post just before I jumped onto this from Karen Spoor, and I don't often, or just happened to come up on, I think it was on her story, and she was lying in the sun. You could just see her feet. She said, after a day of ups and downs, or a morning of ups and downs, that's just property developing. And she was lying in the sun with her legs crossed. She doesn't go to work. Her work is hanging out with a grandbaby a couple of times a week, and doing a bit of property development stuff, which is cool.
Mm.
So it does give flexibility in lifestyle, rather than being tied to the 8 to 5 forever. And even if you do keep on your 8 to 5, it gives you options for nicer holidays, or setting
Yeah.
yourself up for later. There are lots of great reasons, Bob?
Oh, yeah. Something that I heard you say many
Mm.
times,
Mm.
and it's so true. Some people just don't make those decisions, but not making a decision is actually a decision.
Oh, that's my favorite.
I
When
know you
you,
use it a lot,
yeah,
but it's true, isn't it?
yeah, but
That's probably the biggest decision
you'll ever
is
make.
is not making a decision.
Yeah, yeah. It's almost like division, decision. We can get decision fatigue, but we also get in the habit of not making decisions.
Mm.
So when somebody says, "Do you want a tea or coffee?" I go, "Oh, whatever." We just
Yeah. Oh,
allow.
what are you having?
Yeah, instead of saying, "I'll have a cup of tea, thanks," or "I'll have a coffee," or "I'll have a
And
glass
do
of
you
wine."
have peppermint tea? Or
Yeah, yeah. Asking for what you want, getting in the habit of making decisions, because we just stop doing it. We allow other people to make decisions for us, and then we end up not doing the things we want, because we get really lazy at decision making.
yeah,
And whether this be property development or anything you want to do, anything you've considered doing in life. I'm actually speaking tomorrow at an event with women, but this is what I'm going to be talking about. We all have that thing that we want to achieve, and it doesn't matter in what area of your life it is. It could be just to improve your golf handicap, or it could be to go out fishing more, it could be to make more money, or start a business, write a book. It doesn't matter what it is. We all have something that we want to achieve, and we just put it off because we end up being in the passenger seat of our life, meaning
mm,
we let someone else take over and start determining where we're going, because either their needs are more than ours, or we end up looking after people. We become mothers or fathers that have a different role within the relationship. We just so often don't go after that thing we want. Often I hear, I've got to talk to my partner about this. And when I hear that, I think, so if they come back with a no, I'm like, you're not living your dream. This is if you've got a dream, no matter what your dream is, dreams, and I said this on our mentoring training last week, goals are the framework to make your dreams come true. If you have a dream, turn it into a goal, write it down, and make it happen. And that
yeah.
is use a framework, which is goal setting, and make it
It's your
happen.
mantra.
It is. So I've got my wee soapbox there, but it's so important for me that people start doing what they want in life and achieve what they want, because we're not here forever, and we assume we are, and you just have to do what you want, Bob?
Mm. You do, and I
Mostly.
do.
There's a couple of things I haven't done yet that I want to do.
A few things I've got lined up too.
Yeah, yeah, but I'm on track. But there's a few
Yeah.
things I need to do, and I've had a bit of a think about that even this morning. I spent a bit of time working through that in my head, and that's about to go out on paper as well. And that's probably because I'm speaking about it tomorrow, brought it to my forefront. And somebody interviewed me on a podcast this week, and it really sparked me thinking about a few things. So it's not letting those moments go by, even like this. Sometimes we hear things and we think that's a great idea, and then we carry on our normal day. So if residential finance is your reason for not doing property development, well, then understand that commercial finance is an option.
It's the biggest option.
Yeah. And it's one that, what's the percentage? At what, over 90%?
With property development, commercial would go for, I don't know, 98% of probably of development. But in the commercial like compared to retail,
Yeah.
but in the commercial development arena, banks about 20% supplying funding, and non-banks about the other 80. And there's so many types of finance, so many ways of getting finance. Finance varies so much. It's a huge world.
Bob, just quickly before we wind up, just talking about line fees. Just explain what line fees are. I know this was one that got me in the early
Line
days,
fees.
so I thought if I have that question, others had it.
Sometimes in commercial finance, the financier might charge line fees, not always. So what a line fee is, it's more like a management fee. It's a fee that they charge for like managing the loan, and it's generally a small percentage of the loan value. Sometimes they charge it of the fully drawn amount. Like let's say it was 1% of the loan, that might be their line fee, but they charge it from day one sometimes. It's not on a drawdown basis like the loan is, like as you need more money, you draw it down. As the buildings, get completed, you draw down more and more money to pay the bill. It's not like that. And so a 1% line fee charged for the fully drawn loan from the very beginning, that can have the equivalent of roughly 2% interest rate. So you've got to be careful about line fees. You might see a line fee of 1% is quite possibly equal to 2% interest if it's charged from day one on the fully drawn loan amount.
How can they not charge? I mean, if you're not charging it on day one, so the other option is to charge it on drawdown.
Yeah, which is normally the way your loan is done.
Yeah.
And so you just have to be aware of that. Not everybody charges line fees. Quite often they make their interest rate look lower, and then they'll put a line fee
boost in a line fee.
Yeah, and so not realising that the line fee definitely has an effect. If you just concentrate on the interest rate, don't really fully understand the line fee, you might be deceiving yourself a little bit. There's a lot of things to watch with loans in the commercial world. That's why you need a good. Well, initially when you're starting out, I say get a really good commercial broker, an experienced commercial broker who understands all these things.
Well, it's like anything in property development. You just get the right person for the job. You don't look for the cheapest one. You don't look for the new person on the block. You look for somebody. And I know that new people have got to get experience, but maybe they can get experience sidelining with someone who's been around for a while. But it's important that you get the right advice.
Finance is such a big part of your development. It can make you. It's and of course we've seen interest rates rise quite a lot in 2023. So it has an effect. I mean, getting the right finance sorted out up front, it's really critical. It's important.
Okay, well, I think we can wind this one up, Bob.
Okay.
So remember, your life is just made of continuous decisions. Don't get slack. If you've got a goal, if you've got a dream, turn it into a goal and go make it happen. Yeah, you've got to do what you want to do, and property development is a fantastic tool for getting where you want to go. So you're welcome to come join us. We've only got a couple of seats left for our joint ventures workshop in Sydney on the 27th and 28th of July. Yeah, that in fact, somebody messaged me before I jumped on and said they haven't seen their invoice. So I don't know if they're on the list. They're on the list. I'll put them on the list. There is a couple of spaces available. But if you are interested in going to that, the early bird finishes at the 30th of June. And reach out if you've had a product from us in the past. You'll get some sort of discounted rate. Otherwise, if you're new, you'll just jump in at the standard rate.
Yeah, and what you learn there change your whole future.
Change your life. Game changer. Anyway, Bob, thanks so much for talking about your favourite topic, finance. He loves finance. It's his jam. And who knows what we'll be about next week. I hope you've all learned something worthwhile in this week's podcast. Catch you later.
Bye now.
Bye.